Hey everybody, John Collins, San Diego Realtor, Beach Realty San Diego. I am getting this live video going, hopefully, and I apologize to those who thought it was coming a little earlier today. I had some sound and mic issues, so hopefully everybody can hear me. If anybody jumps on and wants to give me a thumbs up or let me know that the levels are okay, I appreciate that, just to make sure that you're all hearing me all right. So the reason for my video today, I was listening to a local lender this morning, and they were talking about people who wait for prices to drop. And in San Diego, it's a reasonable and understandable thing to want to wait until prices come down because prices are really high in San Diego. And the question becomes, is it worth it? Should you sit out this market and wait for the prices to drop, or you'll hear people talk about the bubble popping, and I'll talk a little bit more about whether I think that's an actual thing to wait for or not. But people reasonably want to wait for lower prices, and they think sometimes that that's just the only thing that affects their purchase. And it's understandable unless you're actually in the everyday dealings of real estate to think that the house's price is the house's price, and there's that's going to be the biggest influencer on how much you spend on that house. And of course it is a big factor, but the other big piece of the puzzle, and one that is going to perhaps make you think twice about waiting for a purchase, is the interest rate. Now, for the longest time after the market meltdown in 2008, the Fed kept the lending rates at basically zero. And that isn't a one-for-one influencer, but it does directly influence mortgage rates and how much it costs you to borrow the money to buy your home. So what we've seen starting last year is a slow and steady increase of the Fed rate and a resulting increase in 30-year fixed rates, which is what people just kind of look at as the general indicator, but really across the board, regardless of what kind of loan you're getting, they do creep up as that Fed rate goes up. And they have increased it 3 times in the last 12 months, I want to say, at a quarter rate per. And there is really no indication that they are going to stop doing that because they kept it low for so long. They need to bring that back up to something closer to a normal standard. And until they see some sort of adverse effect by making those increases, they're going to probably keep doing that. Now, what does that mean for you? How big is that effect on your purchase price? So the thing that really struck me this morning, what this lender was talking about and what I wanted to share with you, is what a 1-point interest rate means to you. So we take a house today that you're thinking about buying and say it's $1 million. For the sake of argument, it's a realistic detached home price in here in San Diego. Now, if your interest rate is 4.5%, your mortgage, everything lumped together, you usually put tax and everything in there, per month, could be, for the sake of argument, $6,000 if you put 20% down and all other things being equal. That's a rough estimate for the sake of simplicity. Don't hold me to it, but let's say that's the case. Okay, so a year from now, let's say the market has not gone up at all. It's flat. We haven't seen a bubble pop. We haven't seen a decrease in price. And the fact of the matter is, most of the people who are out there watching the market think it's going to keep going up in the coming years. But for the sake of this example, the house price stays flat. But the interest rate has gone from 4.5 to 5.5. Your payment, having gotten nothing else new or different or better in the house, and your purchase price being exactly the same, is now going to be $6,600. 10% you are spending now in interest that you would not have spent if you bought now. So when you start to consider how much the prices have to come down to offset increases in interest rates, that's where you want to really take a moment's pause, because interest rates are going up. We've seen it. That's the trend. We expect it to keep going that way for the foreseeable future, a little bit at a time, but steadily. Most people out there say the prices aren't going to come down significantly, if at all, for at least a year. And at that point, most the people I am talking to, and my own personal belief, is there is not going to be a bubble. There is not going to be a big crash of prices, especially one like we saw in 2008. You will see a market adjustment, a dip, which on a long enough timeline will go back up again. That's just been the historical trend. But will that dip be big enough to offset the increase in interest rates? And my personal thought is, it's probably not going to justify a decision of waiting when prices in all likelihood are going to go up for the coming year. And so unless you are really willing to sit on the sidelines for years, you're not going to see a huge price difference in prices. And the longer you wait, the more you are likely to be paying even higher interest rates. It's worth mentioning that, we've gotten used to really low interest rates. For a long time, they were going around in the 3s, low 4s. They're up into the upper 4s now. But historically speaking, on like a 20-year timeline, we're talking about an average interest rate of 7-8%. Back in the 80s, people were paying credit card interest rates, 12%. Things that an interest rate that would actually kill, market sales now. They're not going to go there, at least not in the foreseeable future, without some pretty big changes. But, it's worth mentioning that a 4.5% interest rate, or 4.75% interest rate these days is, historically speaking, still a pretty darn good interest rate. And in my personal opinion, worth getting into the market for. All right, I'll wrap this up. I hope this is a helpful bit of information for you guys. Of course, I'd love for you to send me questions or reach out to me directly if you'd like to talk about this further. Thanks a lot. Hope you guys have a great day. Talk to you soon.